Investing in China may seem like a risky move to some investors, but valuations are extremely cheap. Market sentiment on Chinese investments hit rock bottom just weeks ago after President Xi Jinping secured a historic third term in power and stacked his top team with loyalists in a clean sweep not seen since the Mao era. But in the past week, a series of unexpected steps by Beijing, the easing of zero COVID restrictions, moves to salvage the ailing property sector, and Xi's personal return to the world stage have triggered a huge rally. Hong Kong's benchmark Hang Seng Index has gained 14% in a week, and more than 20% above its recent low, putting it squarely into bull market territory. A key index of Chinese stocks in New York jumped 15% during the same period. Top investors from the US and Europe are increasingly making long-term bets on China, as they believe that the world's second largest economy is on a fast track to recovery. Now is the time to make long-term investments in China because the nation is set to bounce back after the pandemic, said Tobias C. Pross, the head of Allianz Global Investors, one of Europe's biggest asset managers. The sentiment is that investors should play the long game. Swiss investment bank UBS expects China's economic growth to recover further on resilient infrastructure and manufacturing, as well as a pickup in consumer spending. Those bullish views are in line with Wall Street, as buy China calls are getting louder. Morgan Stanley lifted its targets for the country's stock gauges last week, expecting the MSCI China Index to rally 14% by the end of the year. The optimism of foreign investors mostly comes from strong policy support from the central government, which has precisely targeted the country's pain points and worked on them. There are currently two obstacles that plague the recovery of the domestic economy. One is the pandemic, and the other is a weakening real estate market. However, the recent introduction of policies has marginally improved these two areas and sent positive sentiment through the market. China's Ministry of Industry and Information Technology, along with two other ministries, jointly issued a notice last week that listed 17 measures to shore up the development of major industries, varied enterprises, and different regions of the country as a stronger move to bolster economic growth. In the real estate sector, the People's Bank of China will launch a 200 billion yuan loan support plan for 6 commercial banks, so that they can help in guaranteeing house deliveries. The inflow of capital also comes amid an unstable international political and economic landscape, such as soaring inflation in the US and a volatile global financial market. Some analysts say that China has become a safe haven for investors to hedge risks, noting that frequent talks between Chinese and US high-level officials has greatly helped build on that positive sentiment. In the face of a resilient Chinese economy and the continuous high-quality development of the Chinese capital market, it is a very rational and normal professional practice for European and US financial market players to adjust their investment strategies and shift to long-term holdings of Chinese assets. China has some of the most powerful and active consumer and investment groups in the world, and the scale effect is very significant. It is also of strategic value to be able to participate deeply in China's reform, which will in turn help them maintain a competitive edge among global investors. These investors, who have experience in mature markets and human capital reserves, can also help China further deepen capital market reforms and establish a comprehensive, wide-ranging, and multi-level financial system. It's hard to ignore the potential opportunity for the Chinese market. As the second largest economy with a nearly $18 trillion GDP and the biggest population in the world, the Chinese market is ripe for growth. There are many reasons to invest in China, including market size, growth potential, human resources and infrastructure, innovation, manufacturing, emerging industries. One unique advantage for data-fueled innovation in China is the size of its internet-using population. China has close to 1 billion internet users, which is more than the US and EU combined. About 800 million people in China use mobile payments on a daily basis, over 8 times more than the US, leading to a world-leading fintech industry. Not only is China a leader in technology and manufacturing, but a substantial portion of China's population is also of working age. In the 1980s, China established special economic zones to support special economic functions like free trade areas. Special economic zones have stimulated development within the nation, while changing conditions and spurred innovation. Greater freedoms in policies and a market-oriented economy have led to the creation of 30+ million jobs, increasing incomes for participating farmers, and accelerating industrialization, agricultural modernization, and urbanization. Whenever you talk about investing in China, you must consider the risks. One central but less mentioned risk is the Chinese government intervening and manipulating the markets as they previously did in the technology sector, primarily with Alibaba and Tencent. And as we've seen over the years, COVID lockdowns had a major impact on China and global economies. Shipping ports were locked down, resulting in supply chain constraints. China has experienced deglobalization trends and negative geopolitical factors. A strong dollar has also limited the appeal of investing in China and has contributed to investor fear. While Xi may be willing to forge a path forward, if history indicates any further geopolitical tension, it will very likely bring volatility back to Chinese stocks, and a reversal in the gains experienced in the past weeks. The opportunities that must be considered are some Chinese companies have strong fundamentals, good valuation frameworks, and excellent growth prospects.